Well, good morning, everyone. My name's Nathan Stelter, president here at the Stelter Company. Very excited to welcome everybody to this special encore presentation. We're so glad you could join us today. This is an encore presentation from this year's national conference, CGP conference in Indianapolis this past fall. I will tell you, after personally attending 25 these conferences the last 25 years, I have never had multiple people come up to me and rave about a presentation so much. One individual saying this was the best presentation he's seen in all the time he's been coming to conferences, and he's been to more than I had. I think he said he'd been to over 30. Another individual is saying this presentation made the conference this year. So while we've had a lot of Stelter webinars and part of our free webinar series this year, this is a very special one, and wanted to make sure for those that were in attendance in Indianapolis, you get some additional information. Lynn said she included a special additional slide as well, but also for those that were unable to attend, that we could spread this information far as wide as possible. So Lynn has already given a variation of this presentation, probably half a dozen times, or no, not half a dozen, 2 dozen. That's different than half a dozen. Close to 25 times across the country since early July. So we're excited again to bring this to you today. And why? Well, really, because the new tax law will influence how your donors give. And Lynn's expertise will give you the insights you need to feel confident about what's changing, how it affects donor behavior, and how to talk to your donors about the impact it may have on their giving. So without further ado, I'd love to introduce, hopefully somebody who needs no introduction, our own Lynn Gomer. Lynn is our senior gift planning consultant here at the Stelter Company with over 25 years of experience in estate and charitable giving. She spent more than the last 13 years at Stelter. Feels like forever, Lynn, but in a good way. In a good way. Advising and working with our clients on technical plan giving issues and ensuring accuracy of our nonprofit marketing communications, along with speaking regularly around the country, not only for Stelter, but at different conferences, as well as writing and authoring our very successful Stelter Expert Insights publication, which covers trends in research and plan giving. Lynn currently serves on the board of directors for our own National Association of Charitable Gift Planners. She previously actually chaired the CGP's Leadership Institute, but this year she is a member of the Government Relations Committee, which bodes well for the talk that we're giving today and that she's hosting and facilitating. She's a current board member and past president of our own Mid-Iowa Plan Giving Council. And she sits on the board of Plan Giving Today and was recently published, hopefully you saw it, the relaunch of CGP's Journal of Gift Planning. She's very busy and she likes to do a lot of marathons. So I will hand it off. I know we've got the next hour or so dedicated. Hand it off to Lynn for a great talk today.
Thank you, Nathan. I appreciate that. Yes, we are coming to you live today for an encore presentation of the CGP conference. If I take you back to the fall, to Indy, this presentation was given, let's see, the last day of the conference on a Friday, just before lunch and during a government shutdown, and people still came to learn about Washington and taxes. So that tells you that this topic is very popular, and we have a lot of attendees on today. So I'm glad you're here, and I'm glad to give this encore presentation. So we are going to talk about the new tax law and what's staying and what's changing and what you need to know about it. And then we're going to look at, beyond taxes and what else you need to know, some things maybe coming down the pike in 2026. And then if you've seen me speak, I always like to give some homework or next steps. And then we have a special segment here. Stay with me till the end because we're going to talk about lost legacies, and you could end this presentation with finding more money for your organizations that you are not aware of, and we are going to walk you through that step. And we have a prize for somebody today. So stay tuned and stay with me to the end. So first of all, let's talk about the tax law. And what do we call it? Usually, this is a very simple question because there's usually a short title in legislation. And so it'll say short title, and this is what you call the new law. But in this case, when it came through Congress and it was in the House and then in the Senate, yes, it was called the One Big Beautiful Bill or the One Big Beautiful Bill Act. But days before President Trump signed the bill, Chuck Schumer had that name removed. And so the official reference is actually HR 1 or Public Law 11921. Not great for marketing purposes. So here's kind of what my thoughts on this. Yes, the media still calls it one big beautiful bill, but I don't advise you calling that in any of your either conversations with your supporters or in any marketing material you will do on your own for a couple reasons. One, as I said, it's not the official name. Two, our country is very divided right now. And I would say, arguably half your supporters will not think it's a beautiful bill. There's a lot in here that is not only not favorable to the charitable giving community, but have eliminated funds like for either Medicaid or reduced funding for other things. So it's not really beautiful. Also, I've also heard. So let's take apart this title here. It is one piece of legislation. I'll give it that. It is big. It is almost 900 pages long. It's not beautiful for, let's say, arguably half your supporters. And when they say one big beautiful bill act, that actually doesn't even make sense because a bill is something that you hasn't been signed yet and an act already has been signed. So it actually doesn't even make sense. Some people say, I've heard them call it OB3. Well, kind of cutesy. Sounds like a little Star Wars-ish, like it's a younger brother of Obi-Wan. So I kind of advise against being kind of cutesy with the OB3 reference and things. So I've just called it new tax law. And I do think your supporters will understand that, we do have new tax law that was signed in July and some of it has been implemented, as we'll see already, and some of it is going to be implemented in 2026. So just to kind of give you let's step back here. It was signed on July 4th. And the reason why we even have this new legislation is because of the Tax Cuts and Jobs Act. And that was signed during the first Trump administration back in 2017, and it took effect in 2018. And some of the provisions, in fact, many of the provisions were expiring at the end of this year. So really just in a couple weeks. So December 31st of 2025, unless Congress acted. So we were going to go back to what the law was before the Tax Cuts and Jobs Act if Congress didn't act. Well, they did. And now we have this new tax law. So it creates some new provisions and it made others provisions permanent. And there's a lot that impacts the philanthropic sector, which we're going to talk about today. So let's start with what is staying. So the first thing is the tax brackets. So we have the extended tax brackets that they are not changing. So when you take a look at your promotional materials, if you just have a reference that a donor gives and they're in the 24% tax bracket, that's not something that you're going to need to update in your marketing materials. But as we're going to go through here, if you have a tax scenario that talks about an individual in the 37% tax bracket, that's still correct, but their tax saving scenario is going to be capped at only 35%. We're going to go over that in a little bit about what's changing, but you're going to have to identify those scenarios and change them before the new calendar year starts here. What else is staying? Well, a higher standard deduction. So let's go back again to the Tax Cuts and Jobs Act, where that nearly doubled the standard deduction. And when that happened, many more individuals or taking the standard deduction now. In fact, that is about 90% of individuals taking the standard deduction. And what the new tax law did is that it gave it a small boost. So originally, the standard deduction for single filers was going to be 15,000 and 30,000 for married, and it gave it a small boost to 15,750 for single filers and 31,500 for married couples. Now, it still has the bonus of 65 and older. They get an additional $2,000 for single filers and $1,600 per qualifying individual for married filing jointly. But what the tax law did, so this is what's changing part, is that for individuals who are over 65, they get an additional $6,000 deduction. If you remember going back to the campaign, President Trump campaigned on no tax on Social Security. Well, there is still tax on Social Security, but this basically replaced it. And so for the years 2025 through 2028, individuals 65 and older within the income tax limitations will get $6,000 an individual. Now it phases out at certain income levels, but still, even more people are going to be taking that standard deduction. And we're going to go over why that's important to know in just a bit. So again, 90% of taxpayers taking the standard deduction, that could maybe go into a little bit higher with this, $6,000 additional deduction for 65 and older. So what does that mean for you? Well, let's think about those that can still benefit. For those who are 70 and a half and older and who own an IRA, they should be making qualified charitable distributions. This gives them tax benefits, and it doesn't matter whether they're taking the standard deduction or the itemized deduction because those distributions coming from the IRA directly to a nonprofit, a qualified charity, go tax-free up to, in this year, $108,000. So this is qualified charitable distributions has been really, really becoming more and more popular as people get used to it. Are turning 70 and a half. You've got the baby boomers here. So this is a very important gift type, along with the fact that a lot of money is in retirement plan assets and more specifically in IRAs. Also, appreciated stock or real estate. Again, you get tax advantages. Here, more than likely, you'll be above the line if you're giving appreciated stock or real estate. Plus, of course, you get the benefit of no capital gains tax if that asset is transferred directly to the charity. So, and then remember, I'm going to bring in my friend Dr. Russell James here. He's the professor out of Texas Tech. If you're not familiar with him, he does a lot of research on giving and what donors are thinking. And he has found that nonprofits who consistently receive non-cash gifts and promote non-cash gifts grew 6 times faster than cash-only organizations. So really think about, promoting appreciated stock and real estate in your upcoming 2026 communications. Now, with the standard deduction, I'm sorry, I may have just gone out here. Not everybody is going to be itemizing. So you need to be clear in your donor materials that you say, when you'll get a deduction when you itemize, or you may qualify for a deduction. Don't imply that all donors are going to be receiving a deduction because that is not the case. Again, 90% of taxpayers are taking the standard deduction. Oops, Jen, I'm having trouble advancing these slides. Okay, there we go. So now, when the Tax Cuts and Jobs Act came into being and the standard deduction doubled, a new strategy came about called bunching gifts. I personally had never heard of it before, but bunching is basically combining multiple years worth of giving into a single tax year and then taking an itemized deduction. Then in the following years, maybe either decrease that giving or maybe going into DAFs, and then taking a break for maybe years 2 and years 3, and then giving again. So for example, here's a donor who typically gives $15,000 annually. They may give $30,000 this year to get over that standard deduction, itemize their deduction, and then next year maybe not give. Or what you can do is if you have a donor who is doing this bunching of gifts, instead of just having them not do anything in year 2, maybe talk with them about a planned gift or something like that. So maybe really talk to them. Well, say, hey, annually you're giving this amount of money, but now let's talk about beneficiary designations or a gift in your will to really, what's going to happen to the programs you support or the scholarships you report or that you support while, get during your lifetime, and maybe put a planned gift in place, during those odd number of years when they're not bunching their gifts and taking the standard deduction. Now, I think we're going to see a large number of individuals increase their DAF giving here because, from their perspective, they don't want to really not give in years 2 or years 3. They want to continue that normal cadence of giving. So what they'll do is they'll bunch into their DAFs. They'll give that 30,000 into their DAF and then continue to give in years 2 and year 3 by making either recurring distributions or just recommending grants during that time. So I think we're going to see much more DAF activity going forward as well. What else is staying? The higher deduction for cash gifts. So as this went through Congress, the House actually had this going back to 50% and the Senate and then the Senate moved it to 60% and really extended it. So I was glad to see that change happen kind of in the 11th hour. We also had fixed a little glitch here that right now, when donors combine cash and non-cash assets, when they stack their gifts, sometimes that top deduction can be reduced to more like 50% of their AGI. But going forward, that little glitch has been fixed, and they can deduct the full 60% of when they're combining cash and non-cash gifts. So that little glitch has been fixed. So maybe encourage your philanthropic donors to consider blended giving, like cash and non-cash assets, to maximize their deduction and impact. What else is staying? Higher estate tax exemption. So right now it's at 13.99 million. That will increase via inflation to $15 million per person and $30 million per couple. This is only about 0.1% of individuals who will be impacted by that. So when you are talking to donors, when you're looking at your own marketing materials, please avoid language like your estate's going to receive a federal estate tax deduction for your gift. Okay, well, true for those over 13.99 million this year. I do think it's overstating tax benefits when you say things like that because it impacts so very few estates. So, like in the Stelter materials, I don't reference the federal estate tax deduction except on very very unique circumstances, or maybe when I'm talking about charitable lead trusts, but that's like a higher net worth type of gift. So anyway, I would just avoid it in your general language, like when you talk about like giving through your will or something like that, to not talk about receiving that federal estate tax deduction. Now, what is changing? Well, we have a new tier tax rates for private colleges and universities. So right now it's at 1.4%, and the new tiered system is really focused on private colleges and universities with over 3,000 tuition paying students. And you'll see here what it is. So 500 to 750,000, it's at 1.4%. It increases from there to 4% and then to 8%. Right now, about 55, 53, 56, somewhere around there, private colleges and universities are impacted by this. I'm going to be curious to know how many more. I've read different numbers on that, anywhere from like 10 to a dozen more private colleges and universities will be impacted. So if this is you, I definitely would reach out to your donors may be concerned about this, and what happens if you're impacted, what's going to happen to maybe some professorships, some scholarships, where is this money going to be coming from to be paying taxes? What programs are going to be eliminated? So be prepared to talk to your donors about this if you are impacted by this. And what is going to be what's going to be eliminated because taxes are going to have to be paid on these endowments. Temporary increase for SALT deduction. So this is really going to impact those in higher tax states like California, New York, Connecticut, New Jersey. That's just to name a few. It's not going to impact so much on those states that have no income tax, like I would say like Texas or maybe South Dakota doesn't have an income tax. So, but it increases the SALT deduction tax from 10,000 to 40,000. And then it only till 2029, and then it resets to back to the 10,000, and it adjusts each year for inflation. So this might be some good news for those in these higher tax states, because they're going to be itemizing their deduction, and it may lead to increased charitable giving, and allow them to deduct their charitable contribution. So stay tuned here. It's going to be interesting to me as we move forward here how this impacts charitable giving. New giving threshold for corporations. So right now, there's no threshold for corporations, but beginning in 2026, corporations are going to have to donate at least 1% of their taxable income to qualified charities to maintain eligibility for certain tax deductions. According to Ernst & Young, this could be an annual reduction of corporate giving from anywhere from 4.2 billion to 4.8 billion. So not great news for those charities who are receiving corporate, partnerships and donations and things like that. So, um, here's what I would do in the final weeks of the year. We've got what, 3 weeks left or so. Reach out to your corporate partners. They should be familiar with this by now, but just in case, I would reach out to them and talk to them about the 1% floor implications. And maybe they want to give more in 2025 before this new tax law takes effect. Now, strategic planning in 2026 and beyond. I think corporations could start bunching their gifts. Again, that's concentrating multiple years of corporations into single tax years, or use corporate DAFs. They could start using more corporate DAFs and then again maintain that normal cadence of giving. So this will be interesting. But again, in the last few weeks of the year, reach out to those corporate partners and talk to them about this 1% floor. New giving threshold for itemizers. So those who are itemizing, that's your 10%. That's probably, your higher net worth donors, your major gifts donors. And so the new law is going to require taxpayers to give at least 0.5% of their adjusted gross income in order to receive any tax benefit from charitable giving. So I have an example here of an individual who earns $200,000 in adjusted gross income, and they won't get a tax break unless they give beyond that $1,000. So if you haven't already, you need to be talking with your donors about this provision because it will be more beneficial for them to give this year before the new law takes effect. Now, when we get to 2026, I could see them bunching gifts again and possibly bunching gifts either directly to the organizations or bunching gifts into their donor advised funds. Again, this is why I think DAF giving is going to be really exploding in popularity beginning in 2026. So if you're not talking about recommending grants in your marketing material from donor advised funds, I think you're going to be missing out. Uh, so, so not a great provision for nonprofits, but I do see some strategies here emerging with like I said, bunching and DAF giving. But in these final weeks of the year, make sure that your high net worth donors, those who are itemizing, and you may not know who's itemizing, but I would focus on the high net worth individuals or who are giving, major gifts and things like that, who are likely to be itemizing and talk with them before the end of the year. New limited deduction for tax sprayers in that top tax bracket. So this goes back to like one of my first slides. So if those individuals who are in that 37% tax bracket this year, they're going to be able to deduct 37 cents on the dollar. But beginning next year, they're going to only be there. That's capped. It's capped at 35 cents for each dollar. So you may want to think like, oh, well, it's 2 cents. Like that's not a lot, but it adds up and it adds up quickly. So, and the Indiana University Lilly School of Philanthropy projects that this cap will reduce charitable giving by 41 to 61 billion dollars over the next decade. So, for those who are in that highest income tax bracket, if you do know who they are, I definitely would be talking to them this year as opposed to next year. And then, for your marketing tip, you need to look at any scenarios where you're referencing that 37% tax bracket and then you have like some tax saving information in there, like they're going to get a charitable deduction of this amount. You're going to have to adjust that to limit it to 35% or 35 cents on the dollar instead of 37. Now for some good news. The universal charitable deduction returns. So I'm thrilled that this is in there and it's in there permanently. There's no end date here. It begins in 2026 and this is for non-itemizers. This is the 90% of who's taking that standard deduction. So they are able for individuals, they're going to be able to deduct $1,000 and for joint filers, $2,000. This is only for cash contributions to public charities. Contributions to DAFs are not eligible. Okay. The Joint Committee on Taxation estimates that this will generate 74 billion over the next decade. And I think it's going to be more, and here's why. I think this opens doors for the average donor in 2026. When we look at Giving USA numbers, we have seen the number of lower level donors shrinking every single year for a while now. I think it's probably at least like the last decade or so. So I think this is an opportunity to get those average donors, those lower level to maybe mid-level donors back, and then you have a job to do. Your job is to retain them, and your job is to continue to steward them. And hopefully, they turn this into a planned gift eventually. So that's my hope, and that's what I hope for all of you. And so that's my challenge to you is to take these, possibly new donors or donors who will be taking advantage of this universal charitable deduction and turning them into plan givers. So strategic planning for 2026, develop clear messaging that explains the benefit to non-itemizers. I would especially do it at the beginning of the year because it's the shiny new penny, right? This is something that you can promote. I would do it at any time during the year, but also at the end of the year because people may forget about it and realize, oh, it's Giving Tuesday and it's, before year end, I want to give to my favorite charities. They may have forgotten about this so that it'll be a nice reminder for them as well. So I'm thrilled that it's here. I wish it was more, but it's always when we look at items in provisions in the law, it's harder to get things into a bill than to increase that amount later. So I'm hopeful that maybe with some lobbying over time that this can be increased each year. This does not this $1,000 and $2,000 figures do not increase for inflation. So we were hoping that, maybe that provision can be incorporated in future legislation. Now, I wanted to bring you back to the CARES Act for just a second here. If you remember, that was in 2020 and 2021. We had the universal charitable deduction, but it was limited to $300 for individuals and $600 for married filing jointly. 90 million taxpayers took advantage of this incentive, leading to $30 billion to charity. And that was, roughly a third of what it will be, right? So it boosted the number of small donations by nearly 11%. And then after the expiration, it declined. And so I'm thrilled that this is back. I wish it was more, but I do think it's an open door for many, many donors. Now, after this webinar, as Jen stated in the beginning, I have a sample tax law donor letter for you. It will be sent out after the webinar. It really summarizes what I've just talked about today, and encouraging those in the high net worth category to really think about giving this year as opposed to next year. So that will be sent out along with the recording and everything. So look for that. I think Jen said by the end of the week, so that's tomorrow. So you'll get that as well. Now, I wanted to talk a little bit about beyond taxes. So this bill or this legislation uh, did not only did it take talk about taxes and everything like that, but it also cut social programs and financial aid. There were reductions in Medicaid, food assistance, student loan system. So I'm sure you're feeling it, and that's what I heard at CGP, that there's higher demand for services. We're seeing that especially with food banks now, and I know tuition assistance. So there's a strain on nonprofit resources, and so the one thing that you want to do is continue to communicate how your organization is filling the gaps left by government cuts. And so I just hear stories all the time about, the government funding has been cut, or maybe it's been paused and not restarted. And so the donor support matters more than ever. I actually just talked to an individual who was in public broadcasting yesterday, and she was saying that donors are stepping up, and I'm really glad to hear that, and I hope it's the same for your organizations. So now we're going to take a look ahead. So this is the bonus content. I just wanted to include this. This was not not at the CGP conference because I didn't have this information, but the ACGA rates, the rates that the suggested maximum rates set by the American Council on Gift Annuities will remain the same as we enter the new year. They typically review that. I mean, there's always an ongoing review process, but we typically hear from them about twice a year in the spring and in the fall. But they recently announced that rates will remain the same as we enter the new year. So those are the highest in nearly 2 decades. So it's a great time to be promoting gift annuities. So really think about that in your communications, and then with your so many baby boomers retiring, so many baby boomers turning 65. I think it's 10,000 baby boomers turning 65 every year. Gift annuities are great great source of retirement income, right? So really promote that as well. And then I have the QCD inflation adjusted numbers for 2026. Currently it's 108. Beginning in 2026, it'll be 111. And for split interest gifts, that's where you can give an IRA to set up like a gift annuity or a charitable trust, though that amount is pretty small for a charitable trust. It's 54,000 this year and 55,000 next year. So now let's take a look ahead beyond taxes. So with whoops, I think I went. There we go. So this is this IRA charitable rollover facilitation and enhancement act was started in I think it was brought to introduced on April 10th, and it has bipartisan support. And right now, QCDs are only available for an outright gift. They are not allowed to fund a DAF. But this legislation would allow it. And so I'm the chair of the 2026 Government Relations Committee, and we started polling nonprofits. And I did a poll, a kind of an informal poll at the CGP conference, and the reaction is actually mixed on this of whether this would actually whether you support this or not. You know, some individuals said, "Oh, it's a nice opportunity. It's yet another avenue for seniors to give from their IRA to their DAFs." And I think it's great. And while others were saying, no, 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 it's not so great because then we just have to, instead of going, the dollars going directly to our organizations, they're going to a DAF, and then we have to recommend it from the DAF. So the reviews are mixed on this. And then I asked the follow-up question at the CGP conference. I said, well, what happens if there were like mandatory payouts for DAFs, and that started changing some people's minds. I don't see that coming down the road, but given that this is bipartisan, we could see this as part of a larger retirement package in 2026. So we've had the Secure Act, we've had the Secure 2.0, so think Secure 3.0 for 2026, and we'll see if this makes it in. So I just wanted to start ending this presentation of why donors give. So I know we've had a lot of information today, and some of it not so great for the nonprofit community, but I just wanted to just remind you of how the motivators for making a plan gift. And this is from Giving USA's 2019 Leaving a Legacy report. And it's because the cause is personally important to me, or belief that the nonprofit makes a significant impact. Take a look at where reduced taxes is on this chart. It's at 10% and in the middle there. Now, some people will say, oh, that's true. People give because the cause is personally important to me, or, we're making impact, while others will say, oh, I don't know. People might not really say that they're giving because of taxes, so this could be skewed. Whatever the reason, it's a pretty big difference though. And so just remember how important your organizations are in the communities. And then I want to give you all a shout out. Look at number one here. How nonprofit first informs donors. It's a conversation with each and every one of you. This is why stewardship is so important. Yes, mailings at number two, and other printed communication comes in at number three. Your website comes in at number four. Events followed that. But it's a personal conversation with you. So, and it all works in conjunction with your printed materials and your emails and any events you're hosting. So just really, get out there, be conversing with your donors. If you can face to face, it's great. I understand Zoom is, it's a great option as well, but really have those personal conversations. So now I have some homework for you. Nonprofits can lead through change. So I know this year has been just with has a lot of change between executive orders and new tax laws and all of that, but really apply some of the lessons we've learned, from the recession or through COVID. We at Stelter have learned that strong, sustained gift planning programs lead to long-term success. Now is not the time to fall silent or back down. It's really the time to communicate, preserve those donor relations through continued communication. And yes, you may have to pivot your messaging, recognize that there's some uncertainty, but keep focused on your mission and impact. And make sure to diversify your funding. If you are getting a lot or you were getting a lot of money from the federal government, take a look at corporate partnerships, take a look at private foundations and of course your donor base as well. Maintain personal contact. We just talked about that. Phone calls, video calls, promote get proven gift vehicles. So gifts in your will is continues to be the most popular and easiest planned gift, followed closely by beneficiary designations, which are so easy and can be done online without the need of, an attorney. QCDs and DAFs becoming more and more popular. And I think we're going to see them surge in popularity even more in 2026 and beyond with the new tax law here. Charitable gift annuities. So we just heard that gift annuity rates are going to be remaining high. So that's great news. And especially for the baby boomers looking to not only give, but also to give something, also to receive something in return. We're still looking for CGP advocates. So if you're interested in becoming involved, we need you. And there's a link there where you can sign up. And we're looking for individuals who would like to get involved in, and possibly connecting with their representatives in Washington about and listening to your stories about donors and how these new laws are impacting your organizations. So it's easy to join. You just sign up online and we may need you for to sign on to a letter or maybe joining a virtual Hill meeting or something like that. And then become an active fundraiser. If you haven't put your own planned gift in place by the end of the year, do it. You can certainly do that so easily with a retirement plan or life insurance policy. If you do that, your conversations with your donors, not only now, but into the future, will be so much easier for you. If you haven't joined your local plan giving council, I would recommend you do so. I've had the privilege of doing this presentation to a number of plan giving councils across the country this year, and I've met so many wonderful people. There's a lot of networking and camaraderie in these councils, and I just loved hearing their stories and things. So I would definitely join your local plan giving council. And CGP, the National Association of Charitable Gift Planners, hosts regular advocacy updates. So if you're interested in keeping up to date, the next one is on December 18th. I think it will be a panel discussion among several of us about the new tax law. So if you have, questions, please bring it to that update as well. Now for the fun stuff. Are you ready? So here's your bonus where you can maybe go home with or go back to the office with some more money than you started this presentation. So lost legacies. We know that many individuals do not raise their hands and tell you that they have put a gift in place in their will, in their life insurance policy, naming you as a beneficiary of the 401k or whatever. And sometimes what happens is that the administrator doesn't connect with the nonprofit. In fact, in many of the documentation that underlies the life insurance policy or the retirement plan, it will say specifically that there is no duty to locate a beneficiary. So if your donor doesn't inform you and the administrator has no duty to locate a beneficiary, what happens with that asset that names your charity and you don't even know about it? Well, for the near future, it stays with the company. but eventually it will escheat to the state. The state typically where the administrator is. So there is money out there for many nonprofits. And when I did this exercise at CGP conference, it was a standing room only, and I would say about 85% of the people found money for their organization. So we're going to go through this right now, and I'm hoping that you find money for your organization. So if you are a nonprofit that is on a national level, or you are in higher ed and have, alumni nationwide, I want you to either grab your phone or, go on to a different tab on your computer, and I want you to go to missingmoney.com. Now, Jen's going to walk us through this. And so if you're one of those, I want you to go to missingmoney.com. And what we did here is we went in and I looked at the registration list and I picked out Wounded Warrior Project. They are near and dear to my heart. My son is in the Army. My daughter-in-law is in the Navy. And they certainly see how this organization helps wounded veterans. So we went to missingmoney.com, and what I want you to do is put your organization's name in there. We're just doing this as an example. And take a look at what Wounded Warrior Project, how many claims there are in missingmoney.com. You see things from Wells Fargo. You see accounts from like Co-America, U.S. Bank, PNC, Prosperity Bank. It goes on and on and on. And for Wounded Warrior Project here, there are pages and pages and pages. When I did this presentation to the charitable gift planners in Houston, one major university had 11 pages of claims. Now, I will say that not all of these are lost legacies. Some may be some other things associated with like the university or something like that. But this to me seems like it's more lost legacies. So you can just see the number. And often it will say like undisclosed or just over $100 or something. That's really just for security purposes because the 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 organization doesn't want to be stating how much money is out there for security reasons. So you can see on all the different states here, Texas, California, Nevada. That's why missingmoney.com will look at the nationwide as a whole. Now, if you are doing this, I want you to put in is it the chat, Jen? How many claims, count them, how many claims your organization had, and we're going to have fun with this.
Yes, I
Now,
have opened up the chat.
okay,
So go ahead and drop it in there.
awesome. Now, if you're a more local organization, maybe you're a local animal shelter or a community food bank. What I would, so I know individuals are on here from Atlanta Community Food Bank. So if you're more local, I want you to put in Google like your state and then unclaimed property and start walking you through. So we went through Georgia unclaimed property in this exercise. Each state is going to be different and it's going to look a little bit different. So here we have to click actually a few times to get to where we want to be. But you search for unclaimed property and again, put your organization's name in the last name or company section. And so that's what Jen is doing. And then she'll search for properties.
And you do not need the first
Yeah.
name.
You don't need the first name or the city.
But you do have to click this button.
And again, it's different for each state. And take a look at all of the lost legacies for Atlanta Community Food Bank. And you see them here. So Again, I want you to do this exercise right now. Put it in the chat because we have a prize for the individual who has the most claims out there for their organization. So Jen's going to be looking at the chat. And now when I did this at CGP, I had prizes and I started out who has more than 10 claims, and probably like 75% of the individuals kept their hands up, and I went, okay, 20, 30, and people said, keep going, keep going. And I finally gave out prizes for over 50 claims. So I really hope that you find money for your organization. In the alternative, if you don't, go ahead and put your own name in there. You might find some money, and I've had that happen as well. So I
So
just,
I have been watching the chat and we have people that have over 1,000 claims. So go ahead and put that in there. The chat, I've saved the chat after the webinar and I will go through and find the person that has the most. So be honest and then you will get, I will send you something.
okay. Thanks, Jen. Well, I really hope it sounds like everyone's finding some money, or at least many of you are finding some money for your organizations. So just to follow up on that, it's very easy to submit a claim. You'll just need you'll go through the process. I've always found it to be pretty easy, and then you'll submit some documentation, and that's how you'll be able to claim the lost money that's out there. What I can say is this: your donors did not intend for their money to end up in a state's unclaimed property account. So please go ahead and take the time to claim that. And then going forward, I've talked to many individuals who have many organizations who have a dedicated person who routinely does that, like on a yearly basis or on a quarterly basis. They will go in and just search to make sure that there's no unclaimed property out there.
Fantastic. So we do have a lot of questions, Lynn. Should we answer
Okay.
some?
Yes, I got about 6 minutes here. Sounds good. I'd be happy to.
Okay. There seems to be a lot of confusion about the 1% cap on the corporations, the minimum 1% to nonprofits in 2026, and understanding why is that a negative thing? Wouldn't that be a positive thing? What has changed that? It sounds like it's going to be negative now.
Yeah, so I think it could be looked at a different way. So for those organizations that, yeah, if you want to go back to the slide, that would be great. We could just have it up there. So for those organizations didn't, who don't come close to that 1%, they may just say, I'll just maybe continue to give at my local level. But maybe some organizations will actually say, well, I want to get over that and give more. But they're also, but like the Lilly School of Philanthropy and this EI report sometimes will say, well, I'll just give about 1%, take my charitable deduction, and that's it. So it's going to be interesting to me how this annual reduction that Ernst and Young is stating is going to happen, and I am going to be interested in talking with individuals in the charitable sector about, what are you hearing from your corporate partners? Are they pulling back on their giving because of this? Are they giving more so they can get over the threshold? Are they
Is there a
bunching?
threshold right now, Lynn?
No, there's not.
Okay, so
There,
that's the key is that there's not a threshold. So this will possibly keep corporations that don't want to get over the 1%. They don't want to give 1% and they
right.
stop
And
giving.
maybe they, won't give, or just, give a little bit, but they won't get any benefit from it. And see, those corporations, in 2025 are getting a benefit even if they're giving less than 1% of their taxable income. So we'll see.
The
Stay
very first
tuned.
question. Oh, I'm so sorry.
It's
The
okay.
very first question that came in has the most likes, so let's get to that one. Should charities consider marketing the idea of rolling a retirement account like a 401k or 403b, et cetera, into an IRA to take advantage of the QCD feature?
Yes. So right now, so just to make sure we all understand the details of qualified charitable distribution, it has to come from an IRA. Okay. So it can't come from our 401k. Now, some 401k administrators will allow the individual to roll it over to an IRA, and then the individual who's over 70 and a half can make a qualified charitable distribution. I actually had this exact question yesterday from one of our clients. So it is a multi-step process, but it is definitely something that is available. Uh, Now the question is, I think, do you market it that way? I mean, yes, I think you can certainly say that, if you have a 401k or like a thrift savings plan, or a 403b, that's similar to a 401k, but typically for education. Yes, I mean, go ahead and market, and walk people through that. If you don't have an IRA, that you can roll over, in some instances, you can roll over your 401k or your 403b or thrift savings into an IRA and then take advantage of the QCDs.
One more
Yes.
question, for, you talked about the colleges, increasing, yeah, a couple of percentages on, I think, the endowment, depending on the endowment size. Are, graduate schools included in that?
It's private colleges and universities. So if a private college and universities has a graduate program, I would say yes. Now, I think maybe the question is, are they including graduate students
Mm,
within that? And I would actually have to double check that. So if that's your question, go ahead and send me an email and I will just double check that the numbers include graduate students or not. I will double check that.
Great, thank you. We are out of time, so there are a lot of questions in here we didn't get to, but Lynn has offered her email address is on the screen. Jot it down. You'll also get these slides, so you'll have it available to you tomorrow. You can reach out to her personally with the questions that you had in the question box. You can also reach out to Nathan or myself if you have questions about Stelter and what we do, things like that. Like I said in the beginning of the webinar, we are recording it. So as long as that worked out, I'll send you the link to the recording. You'll get a PDF of the handouts and also that sample donor letter that Lynn has written for you that you can just customize for your organization, to talk with your donors before the end of the year. So that's all we have for today. Thank you so much, Lynn, for agreeing to do this again. We had over 200 people on the line with us. So
Awesome.
another great job of getting this information out to nonprofits that need it. So thank you so much. And thank you everyone for being here with us for the last hour. We appreciate it. And this is officially our last webinar this year. So look for us again back in 2026 for our 2026 webinar series. And we hope that you all have a wonderful holiday season, a wonderful and safe holiday season. Thanks so much. Have a great
Thank you.
afternoon.
Bye-bye.
Bye-bye.